If you or a loved one needs care and you've established that you will need to pay some or all of the cost yourself, this makes you a self-funder. There are 9 main ways to pay for your care, which I summarise in my video, Paying for Care as a Self-Funder. In this video, I will explain the first of those 9 options, using a deferred payment scheme. Since April 2015 and following the introduction of Part 1 of the Care Act 2014, local authorities in England have had to offer a loan, often referred to as a Deferred Payment Agreement, or DPA. A loan to meet care costs secured on the home of the person in care at a fixed rate. This is known as the Universal Deferred Payment System and was introduced to ensure fewer people were forced to sell their home in their lifetime to pay for their care. It should be made clear that the payment for care and support is deferred, not written off. The costs will have to be repaid by the individual or a third party on their behalf at a later date. Variations of this option exist in Scotland and Wales, but in Northern Ireland there is currently no formal deferred payment system. So who's eligible? The regulations specify that someone is eligible for and so must be offered the option of a deferred payment scheme if they meet all 3 of the following criteria. 1. Their needs are to be met by the provision of care in a care home. This is when someone is assessed as having eligible needs which the local authority decides should be met through a care home placement. 2. They have no more than £23,250 in assets, excluding the value of their home, i.e. in savings or other investments. 3. Their home is not disregarded. For example, it is not occupied by a spouse or dependent relative. In other words, they must be someone whose home is taken into account as an asset in the local authority's financial assessment, and so might need to be sold to pay for their care. If someone is eligible, the council will pay their care home bills on their behalf. The person in care can delay repaying the council until they choose to sell their home or upon their death. They will sign a legal agreement with the council saying that the money will be repaid when the home is sold. The local authority usually ensures that the money owed in care fees will be repaid by putting a legal charge on the property. It does this by contacting the land registry to place the charge. The charge is removed when the outstanding debt is repaid. Usually, no more than 90% of the value of a home can be used in this way to pay for fees, less the lower capital limit of £14,250. That's for the financial year 2020-21. In practice, many local authorities will set a limit between 70% and 80%, and this is to leave the homeowner or the executor of their will with enough money to cover the sale costs and to make sure the local authority gets their money back if house prices fall. So, what does it cost? The charge for setting up the agreement tends to reflect the actual costs that the council incurs. There may also be an annual administration charge on the anniversary of the agreement. The setup charge and the annual charge can normally be paid separately, or they can be added to the loan amount. These charges cover legal costs, land searches, registry and valuation charges. It's important to note that local authorities are not permitted to operate a deferred payment scheme at a profit. They can only cover the costs involved. By way of example, in Dorset, where we are, in Dorset County Council, the set-up costs are currently around £800 and the annual fee no more than a couple of £100. Local authorities can charge interest from the start of an agreement, subject to a maximum percentage specified in the regulations. For the period 1st of January 2020 to the 30th of June 2020, for example, the maximum rate is 1.45%. Interest is accrued on a compound basis, so it rolls up. So it's a compound basis on the amount deferred and continues until the deferred amount is repaid. It's worth noting that there are a few occasions where a local authority might refuse access to the deferred payment scheme. for a qualifying individual. For example, where they don't think that enough security exists for the loan, and so they risk not getting back the money that they will spend on care fees. Or where someone doesn't have the mental capacity to agree to the loan and no power of attorney is in place. To be eligible for a deferred payment scheme, there should be no one else living in the property who needs to stay there, such as a spouse, a partner, a child, a relative aged over 60, or someone who is sick or disabled. However, the local authority does have the discretion to offer a deferred payment arrangement where a property is jointly owned. Now, this is a complex area, so it's worth seeking specialist advice. So, what happens if you have a deferred payment scheme in place, but your local authority refuses to defer more charges within an existing arrangement? This might happen if the individual's total assets fall below the level of the means test and they become eligible for local authority support, or the equity limit of the agreement is reached. Local authorities must give at least 30 days notice if they decide not to defer any further charges for someone who has an active deferred payment agreement or arrangement in place. Repayment is still subject to the usual terms of termination, and local authorities should provide the person with an indication of how much or their care costs will be met in future by the local authority or from the individual's income and assets. Sometimes a local authority will accept another means of security against future deferred payments, such as the assigning of a life policy to repay the costs on death, or a solicitor's undertaking in respect of the availability of future funds. But a local authority is not bound to accept any of these alternative means of security. Paying for care fees using a deferred payment scheme may be suitable where the individual doesn't want to sell their home to pay for care fees. The property is not sold within a 12-week disregard period, and other funding options are not viable. A friend or relative is still living in the property, but they are not covered by a mandatory or discretionary property disregard. Or the individual wants a cost-effective bridging loan to give them time and flexibility to sell their home when they choose to do so. Perhaps to avoid a temporary dip in the market valuation or to provide time to secure a target price. Paying for care fees using a deferred payment scheme may not be suitable where the owner doesn't want to see the debt created by deferring care fees growing. Alternative means of payment are available, or where another person, apart from the person in need of care, continues to live in the property and they require security of occupation at the point the person in need of care dies. It's also worth noting that if an existing equity release scheme is in place, it may not be possible to join a deferred payment scheme. So, what are the key advantages of a deferred payment scheme? Well, firstly, the council will pay for the cost of care, so you won't have to find the money straight away. There is a maximum rate of accrued interest that the local authority can charge. In a rising market, the value of the house should continue to increase in value, effectively paying towards care costs. And because the house is not sold, therefore not producing capital, individuals can continue to claim attendance allowance, disability living allowance, that's the care component, or personal independence payments, that's the daily living component, if they are entitled to any of these benefits. There are, of course, downsides to consider, such as the ongoing cost of upkeep, insurance, and maintenance of the house. Of course, there's a risk of house prices falling, leaving less money to pay back the care fees. If your health circumstances change and you move from the residential home or maybe even return home, the agreement will most likely end. And in such circumstances, the loan would need to be repaid within a few months. The deferred payment scheme can be a great solution for some people, but it is best to consult an independent financial advisor who's accredited by SOLA as a later life accredited advisor. Someone who can assess all the possible ways for you to fund any care that you may need in later life. They will build a lifetime cash flow that takes into account all of your savings, all of your investments and other assets. And of course, consider your income and expected expenditure for the rest of your life. It will help you evaluate each option. To find out about the other 8 main ways to pay for care, check out the show notes for links to other videos in this series. Thank you so much for checking out my YouTube channel. My name is Justin King, and my aim is to help people to live successful lives. And that often involves understanding your money. If you have enjoyed this video, please press the like button to help more people like you find my channel. And also check out the notes for some useful links on the things I've discussed in this video. For now, I'm Justin King, helping you live your best life.